This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. Asian stocks lower following a big tech sell-off on Wall Street and strong US data, signaling the Fed will be in no rush to cut rates. The US House of Representatives set to vote on new aid to Israel and Ukraine this week. Meanwhile, top Israeli military officials reassert they have no choice but to respond to Iran's attack. China's first quarter GDP growth beat expectations, but retail sales for March miss forecasts, showing consumers still not stepping up. It's just gone 8 a.m. across the Emirates. I'm Bonnie Quinn in Dubai, and let's take a look at these markets. Falling out of bed today across Asia. These are bothered markets, bothered by geopolitical risk, bothered by the fact that the Fed can't seem to get to the cutting cycle. In fact, Bank of America is now saying it might be December. We even have John Williams telling Bloomberg he wants to cut rates this year, but that's not enough for this market. UBS strategists saying there's a real risk now that the Fed actually begins to hike rates at some point if the economy remains this resilient and inflation this sticky. So with all of that going on, we have US futures in the early going pointed lower. This after the S&P 500 fell below 5,100 in yesterday's session. We also have Dow futures and NASDAQ futures lower. Bond yields jumping, the 10-year by more than 14 basis points after those retail sales data came in stronger than expected. We're at 461.17 now. And Brent crude also reflecting that geopolitical risk at $90.56 a barrel. Let's take a look at Asia markets, because we're down more than 2% across the major indices in Japan, in Korea, even China, which did see mixed data, including better growth data. It's lower. The CSI 300 is now down more than 1%. Currencies also feeling the fallout of a stronger US dollar. We had several Asian currencies hitting very real bands and trends today, including the Korean won, which rose above 1,400 for the first time in a long time. And that 1990 level for the yen really coming into focus now, just above 160.2. We'll see if we get there before intervention happens. Let's take a quick look at how Middle Eastern markets fared yesterday. Of course, they haven't opened up today yet, but we did see a mixed response once again. This time it was the Israeli stocks that were lower, so we saw a big turnaround of the session, and the TA35 ended down 1.25%. The Tadawul, though, up 1/3%, erasing the previous day's declines. So the US House set to vote on US aid to Israel and Ukraine this week following Iran's missile and drone attack over the weekend. Meanwhile, top Israeli military officials reiterated the country has no choice but to respond to Iran.
We are closely assessing the situation. We remain at our highest level of readiness. Iran will face the consequences for its actions. We will choose our response accordingly. The IDF remains ready to counter any threat from Iran and its terror proxies.
Bloomberg's Stuart Livingston-Wallace joins us now. So, Stuart, how close are we to an Israeli response, and can we presume that the military rhetoric is going to be the same as the government rhetoric?
Yeah, I mean, I think in terms of timing, it is a little uncertain, although I think the sense within Israel is that it needs to happen fast. So we know that Iran waited, what was it, in the order of 10 days or thereabouts to respond. There's a little bit more than that. I think the response, when it comes, will be faster. The question is, what does that look like? What does a proportional response look like in this instance? So at the moment, the talk is around perhaps certainly hitting proxies outside of Iran, maybe Iranian military assets. I think the outlier is probably having a go at the nuclear facilities within Iran, but there is a real question about whether Israel can achieve that by itself. It will probably need US help, and Biden has made it absolutely clear, so far at least, that they're not going to be helping them.
How are Western allies and Arab nations as well likely to react?
Yeah, so I mean, I think there's two different responses here. So in terms of the Western allies, there's clearly been this furious diplomatic flurry to try and contain the situation. And I think initially they were hoping that basically the failure of the Iranian attack on Israel would allow Israel to declare victory and therefore not to respond any further. That is clearly not going to be the case based on everything we're hearing out of Israel. In terms of the Arab nations, they're in a precarious position because they fundamentally all want a peaceful region. You know, it's really bad for business and it's really bad for the future of the region if there's this constant tit-for-tat across the two of them. So it's a difficult position for them, and it's not clear they really have a playbook for how to deal with this.
Stuart, thank you. We'll await more in the coming hours and days. That is Stuart Livingston-Wallace here in Dubai. I do want to break some news now. Microsoft planning to unveil $1.5 billion of an investment in G42 as soon as Tuesday. Of course, that's the tech conglomerate based out of Abu Dhabi, which is chaired by the National Security Advisor, Sheikh Tamim bin Zayed Al Nahyan. It's been ambitious. We've seen it make some partnerships, particularly with Microsoft before, and also some acquisitions. It has a data center unit as well, of course, and it is trying to compete on customized chips with NVIDIA. Well, we have this from the New York Times now that Microsoft is planning to unveil a $1.5 billion investment in its partner G42 as soon as today. China's economic growth beat expectations in the first quarter as the industrial sector powered forward. But a tail-off in March activity signaled more support may be needed to sustain that momentum. For more, let's bring in Asia economics correspondent Katya Dmitrieva. So, Katya, it originally looked like it was better than expected news, right? But there was a lot of other data in the data dump today that suggested that things may not be so rosy as to suggest that GDP is going to continue being better than forecast.
Yeah, that's right. I mean, usually you have an economy that reports much higher than expected GDP, that was higher than all analyst estimates. It's usually a good news story. In this case, it's more of a story of unbalanced growth. I mean, we had a GDP figure that exceeded all estimates, but we also had retail sales figures that clearly show that the consumer is just not back yet. We also had real estate data, both home sales, residential market sales, as well as investment, and those are not doing well either, which frankly is what economists had expected. You know, there are no signs really of a recovery in the real estate market yet, especially when it comes to the secondary market, sort of secondary cities. We're still looking for a recovery there. And in terms of domestic consumption, that's also a very big question mark. This has led a lot of economists, at least today in the notes I'm seeing, to forecast that the government will have to step in and really start injecting the economy with more stimulus of some sort. There is, on the retail sales component at least, on the consumer component, some silver lining. There's a big program that the government has going right now for trading in some older appliances that's seen to add to GDP in the future. But as for right now, it's very clear that China is relying heavily on its industrial sector, heavily on manufacturing, and that just doesn't make for a very balanced recovery.
Katya, China also unexpectedly weakened its yuan defense today. Is this all related? Is it helpful to have a weaker yuan?
Yes, monetary policy is another big variable here. I mean, you have the Federal Reserve that's likely to delay any rate cuts until much later in the year, sort of a September, as opposed to June or July. So that has a big impact on Asian central banks, who are likely going to have to move out their own rate cuts even further, because any kind of delay in cutting, or rather if they move before the Fed does, that puts an incredible amount of pressure on their currencies. They want to avoid doing that as much as possible, especially in China, which is doing, very well and actually benefiting in some ways from the currency, because if you have lower priced products, it's currently in a period of deflation, you can actually sacrifice a bit of profit for volume. You can, start trading a lot more product, get those numbers up, as we saw in GDP and export numbers, and then kind of, hope for the best later on. But as we see in GDP, that's not a very strong growth strategy.
Katya, thank you so much for all the context and for joining us today. That is Asia economics correspondent Katya Dmitrieva. Still ahead, Arkham Capital expects oil prices to remain elevated due to supply concerns and growing tensions in the Middle East. We'll discuss, but up next, the latest market moves. This is Bloomberg.
real interest rates now are considerably higher than they were before because inflation has come down quite a bit. So we will need to start a process at some point to bring interest rates back to more normal levels. And my own view is that that process will likely start this year. But again, it's going to be driven by the data and achieving our goals.
New York Fed President John Williams on the Fed's rate cut path there. Well, most U.S. Treasury yields climbed to new year-to-date highs, with the two-year note approaching 5%. This coming after strong retail sales data further eroded investor confidence in rate cuts. Let's bring in MLive strategist Mark Cranfield to digest all of this. Mark, suddenly we have forecasts for this not starting until December, and even a UBS forecast saying, look, it's not our base case, but it's now much more likely that we could see rate hikes that would end up with rates at 6.5% next year. What's the market doing to try and digest some of this data?
Yeah, what we're seeing today is a bit like that old central bank joke, our dollar, your problem. The whole of Asia is suffering because the US dollar is so strong today, and partly because people are pushing back on their expectations of when the Federal Reserve is going to lower interest rates, if they're going to lower them at all. As you say, there's even some forecasts out there which suggest rates may need to go even higher. But for now, people are acting as though we're going to stay at high yields for a lot longer than originally expected. That's pushing up the US dollar across the board. It was already very strong against the Japanese yen, of course, and against some other Asian currencies. And then today at the China fixing, the daily fixing for the dollar yuan, they allowed the rate to go slightly higher than it has been for a couple of weeks. And that just kicked off another round of buying dollars, selling Asian currencies. We've seen the Indian rupee hit a record low. Dollar Korea hit 1,400 for the first time in a very long time, and other Asian currencies are also tumbling as well. And on top of that, there's obviously a very sour mood in Asian equity markets off the back of the tech weakness in the US overnight. So all in all, it's a very negative risk-off move. Bond markets are relatively quiet so far, but we're not at the moment seeing much of a haven bid for treasuries because, of course, they've got their own issues to deal with, and that is that the US data just keeps on coming in too strong. And that's partly why Fed speakers like Mr. Williams are being very cautious.
Mark, we have to leave it there, but thank you. That is MLive strategist Mark Cranfield with all the context for us there on today's incredible FX market moves. Let's talk now to Rashmi Garg, Senior Portfolio Manager at Al Dhabi Capital, joining us in studio. So Rashmi, you heard Mark there. We're seeing phenomenal fallout across Asia, not just in equity markets, but particularly the currency markets, and of course everything is related. When do we see a Fed rate cut, if at all, this year?
So, see, I think this is a cause and effect relationship, Bonnie. And in terms of Fed rate cut, we know that the Fed has a toolkit at its disposal. And, that toolkit needs to be used only when it is necessary. Now, what the data is telling us right now, we saw very strong retail sales yesterday. We've seen three very strong prints of the CPI, and also the employment market remains very strong. Now, with this kind of a backdrop, it shows us that the economy remains very strong and there is no urgency to cut rates. So I think the rate cuts do get pushed out later in the year. Now, having said that, I do believe that the disinflation process is underway. History shows us that disinflation has never been a linear process, and we will see a few bumps. And right now what we are seeing is that, services inflation has been fairly sticky. We need to see a few more data readings before we can say with certainty when the Fed is going to cut, but I think definitely they get pushed out to later in the year.
We don't know yet, though, right? There is the possibility still that inflation reaccelerates if we continue to get geopolitical risks pushing up oil and we continue to get currencies that are not the US dollar depreciating strongly.
I agree with you there. The geopolitical risk remains a big risk, of course, and the backdrop is not favoring, let's say, a disinflation process from that perspective. If we see any escalation in the Middle Eastern tensions, then oil immediately gets impacted, and that stokes inflation further. So yes, that clearly is a risk, and if the dollar is stronger, then the emerging markets do get impacted, and if we see rate cuts getting pushed further, then dollar remains stronger.
You haven't been making big changes to your asset allocation, even with everything that's been going on the last few weeks. Is that a dangerous strategy?
We started the year on a cautious note after having seen the bumper returns that we saw last year. From the beginning of this year, we were in a rather defensive asset allocation. And from that perspective, we did not need to change it a lot, even with the recent changes coming to fore. What we have done is that we've built a position in gold because we see it as a hedge to geopolitical risk. And also, since the beginning of the year, we had a strong positioning in aerospace and defense stocks. We were positioned in energy. We were overweight in energy. Those things continue. We think the current geopolitical backdrop further adds to those convictions. We were also overweight on semiconductor capital equipment stocks and memory stocks, which we expected to see a rebound. And that was related to the entire AI and data center demand. That demand continues from our perspective. So, yes, we do not really change our asset allocation much right now.
Is it time to reconsider just a couple of those, for example, the semis, given that we've started to see a bit of a sell-off in the megatechs in the US, and also your exposure to Japan with the yen at these levels? Is that not a little dangerous?
Yes, so I will talk about the semis first. We see it as a longer-term story, and what we see right now, if you look at the earnings calls, if you look at really the data coming out of various semiconductor industry associations, there's a very strong demand still for GPUs, for HBM, the high bandwidth memory, and that remains strong. Yes, we have these, macro data points and geopolitical undercurrents that impact the stock market, but we do not see any change in the fundamental story here. So we stick to those calls. And I think the earnings season is also going to be a big differentiator as we see the earnings coming. On Japan, so Japan exporters actually benefit when the yen depreciates. And from that perspective, if you're in a hedged position, if you're hedging your yen exposure, and yet you are exposed to Japanese stocks, the yen depreciation is good for the exporters out there, so we stick to the Japanese call as well.
And you're hedged.
Yes.
Yes. So what else should we do if we're in a little cash and there's a bit of cash to deploy? Do you wait? If markets are selling off today, could this just be a one-day thing, or is this the start of something maybe a little bit more nefarious?
So there are two forces at play here. One, we have the macroeconomic forces, where we see that US rate cuts are getting delayed, and we are also seeing that the economy is very strong. And then we have the geopolitical backdrop. To me, the geopolitics is very uncertain. The macro is not so scary because US economy being strong is not such bad news, honestly. And Fed is there to act. If the economy turns weak, then the Fed is going to cut rates. So from that perspective, we are not so worried. But yes, geopolitics is very uncertain. Any war is very difficult to call. And I think that is where we need to put in our hedges. And that's where we advocate that we have some exposure to commodities, to gold, and we can probably even buy some put options on some indices just as protective hedges within a portfolio.
Briefly, Rashmi, just because we got all of the China data just now, you are maintaining some kind of an approach to China. You're not completely ignoring it, but very measured.
Yes, that's right. So, see, from our perspective, while we've seen a rebound in the Chinese stock market, we've seen some inflows. The problem is not with the stock market, it's with the economy. The stock market is a reflection of the economy. And till that problem is addressed, the stock market is just going to, we might see a rebound, we might see a trade back, but, that is not like a firm conviction trade. So, yes, we are dipping our toes in China, we are being tactical, but we still do not see it as a long-term conviction trade.
Fascinating. Rashmi, thank you so much for coming in today and giving us all that market context. That is Rashmi Garg, their Senior Portfolio Manager at Al Dhabi Capital. Coming up, a look at the severe drought in some parts of Africa and how it's impacting supply chains in the region. Stay with us on Daybreak Middle East and Africa. This is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Bonnie Quinn in Dubai. Let's turn to severe drought in parts of southern Africa. Zimbabwe is considering importing corn from Brazil for the first time since 2014 as the El Nino weather pattern withers crops. Malawi and Zambia also have declared a state of national disaster. Let's bring in Bloomberg's Ondiro Oganga in Kigali for more on this. Ondiro, corn obviously a staple. What impact is being felt?
Vonnie, it's great that you asked that question because at the core of natural disasters like these are people. And SADC is estimating that 20 million people are in need of humanitarian assistance. And if we look at these rainfall patterns from January to March, they're the worst rainfall patterns in 40 years. If we zoom into Zimbabwe, February was their driest month and nearly 80% of the country received below average rainfall. What then this means is that it affects agricultural production. Corn production was slashed by about 20% in South Africa, 60% in Zimbabwe. And their president, in a televised national address, was telling them that they will need about $2 billion to mitigate the impact of this drought. We are seeing kids quitting school because of hunger. We are also seeing kids getting married off in trade for grain. So the situation is very dire in Zimbabwe. If we also look at a country like Zambia, inflation is now on the rise. Food inflation is at 15.6%, and it's mainly driven by the prices of bread, prices of cereal, and prices of meat. And this just goes to speak of the unchecked effects of climate change, because these three countries that have declared a state of national emergency, Zambia, Zimbabwe, Malawi, are self-sufficient countries that otherwise would be able to produce enough to sustain themselves.
It sounds catastrophic. We mentioned Brazil. What import options are millers considering at this point?
Well, the Grain Millers Association will be heading to Sao Paulo, Brazil, to try and acquire 300,000 tons. But this is just a drop in the ocean for a country that consumes about 2.2 million tons of grain annually. White corn is such a staple in Southern Africa, used to make pap and sadza. And the tragedy here is that they cannot import from South Africa because South Africa also has its own shortage going on. This just means that it's going to add to their wage bill. Import is going to be really expensive. And so it's going to put pressure on their inflation, which is at already 55.65%. But then again, this acquisition very, very important because this drought is expected to impact production in the third quarter of 2024 all the way to the first quarter of 2025. So things will get tough before they get better for me.
Oh, it sounds very, very dire. Ondiro, thank you for that. That's Bloomberg's Ondiro Oganga. Let's take a look at how the Middle East markets traded yesterday. It was a shortened day, obviously, but there was a lot of reaction to continued rhetoric out of Israel and out of Iran. We had the Abu Dhabi General Index up about 0.2%. The Tadawul reversing the previous day's declines. Its second day after the Eid holiday, it was up 0.3% at the end of the day. Qatar had a much better day in the Monday session. It was up 0.8%. And then Dubai's General Index was unchanged. Do have to point out that we had a down day for Israel, though. Those stocks down about 1.25% for the TA35. Futures look to be pointed lower. It is a very dour day across markets, both in Asia and, of course, in the US in the Monday session, which saw a sell-off for the S&P 500 of more than 1%. It's broken below the 5,100 mark now, as you can see. It's at the lowest in about 2 months. Its year-to-date gain has been pared. About 6% is what that is now. And then we had bond yields also jumping after retail sales data came in faster than expected. The 10-year yield was up as much as 14 basis points. Do stay with us. We'll continue to follow these markets here on Bloomberg Daybreak, Middle East and Africa. Bloomberg Daybreak, Middle East and Africa. Our top stories this morning. Asian stocks lower following a big tech sell-off on Wall Street and strong US data, signaling the Fed will be in no rush to cut rates. The US House is set to vote on new aid to Israel and Ukraine this week. Meanwhile, top Israeli military officials reassert they have no choice but to respond to Iran's attack. China's first quarter GDP growth beat expectations, but retail sales for March missed forecasts, showing consumers are still not stepping up. It's just gone 8:30 a.m. across the Emirates. I'm Vonnie Quinn in Dubai, where we are experiencing a severe downpour, as you can probably hear and definitely see. It's being reflected, by the way, in the markets because we are seeing a sell-off right across the board. Asia markets are just absolutely selling off thanks to weaker currencies and the idea that the Fed is maybe on pause for longer, if not potentially not able to cut this year at all. We did have John Williams telling Bloomberg that he still expects to cut at some point this year, but it will depend on the data. We have UBS out with a forecast, not their base forecast, but a forecast saying it's now more of a possibility that the Fed hikes next as opposed to cutting. So let's take a look. We have S&P futures and NASDAQ futures down, pointing to a 0.25% decline at the open. We're already below 5,100 after yesterday's session on the S&P 500, lowest now in a couple of months. The 10-year yield up to 460.96. That was a 14 basis point move that we saw across the curve yesterday after those retail sales data came in stronger than expected. And then geopolitical concerns continue to weigh as we see rhetoric back and forth between Israel, the international community and Iran. Brent crude back above $90 a barrel. But let's take a look at the Asia markets because we're seeing weakening currencies, many of them already hitting strong levels this year. So, for example, we had the Korean won above 1,400, much weaker than it has been. That's impacting Korean stocks. We're back below 1,400 now, obviously, but still you can see that's a 1.1% move. Same for the yen. It's stable now, but we're at 154.31. We have strategists out talking about 160.2, which is where the last intervention in 1990 took place, but we may see something well before that. Don't forget the BOJ meeting in 10 days. And the CSI, even though we had better than expected GDP growth data out of China, CSI is down 1% because we had worse than expected retail sales data. Fixed income also showing some signs of reaction because we had foreign direct investment also disappointing. And turning back now to our top story, also a concern for these markets. The U.S. House set to vote on new aid to Israel and Ukraine this week following Iran's missile and drone attack over the weekend. Israeli military officials reiterated the country has no choice but to respond. Israel Defense Forces Chief of Staff Herzli Halevi says they are ready to counter any foreign threat.
We are closely assessing the situation. We remain at our highest level of readiness. Iran will face the consequences for its actions. We will choose our response accordingly. The IDF remains ready to counter any threat from Iran and its terror proxies.
For more, let's bring in Bloomberg's Paul Wallace. Paul, you might expect hawkish rhetoric from the IDF, but what about from the government? Are we continuing to hear this hawkish rhetoric, and it's prompting Iran to sort of also come out with hawkish rhetoric?
Hi, Vonnie. I think it depends what part of the government you're talking about. If you're talking about Benjamin Netanyahu and his Likud party, they're more or less saying the same thing as what we heard from the IDF Chief of Staff Halevi there, that Israel will respond to Iran's drone and missile attack on Saturday evening, but that it will do so in a measured manner, and they're not giving any details on how aggressive or in what form that response will take. If you look at some of the far-right parties in Benjamin Netanyahu's coalition, if you look at people like National Security Minister Itamar Ben-Gvir and Smotrich, the Finance Minister, they're calling for a very hawkish retaliation against Iran. Ben-Gvir said there must be a crushing attack on Iran. They say that this is necessary to achieve a deterrence against Iran and prevent it from any other attack like what happened on Saturday. So they say it's essentially it's essential for Israel's national security to respond aggressively, but we just have to wait and see what Netanyahu decides.
Well, it's essential until it isn't, right? Somebody has to stop in a tit-for-tat type situation like it looks like we're getting into. What, would this mean for the region? Can the U.S. prevent something happening when it couldn't before?
Well, I think it's pretty clear that the U.S., Europeans and Arab states absolutely do not want Israel to come out with an aggressive reaction such as a missile strike or missile strikes on Iranian territory. That's something they want to avoid. If Israel went down that route, I think markets would also, that would be very bearish for markets apart from commodities, and that's part of the problem. There is a fear that if Israel and Iran get into a deep conflict that involves cause aggressive tit-for-tat responses against each other. The oil will spike. That's the last thing Israel's allies in the West, and that's the last thing they want. The US does have a lot of leverage, and let's face it, that while Saturday's attack was foiled, hardly any of the drones and missiles fired by Iran reached Israeli territory. It required so much help from the US Air Force, the French Air Force, the UK Air Force. Israel didn't do this alone, and I think that's something that its allies will be telling it, that, hey, you need us, so you have to listen to us as well. But that doesn't mean that it's guaranteed that Biden and the others will be able to ensure that Netanyahu responds in a way they want.
The President, Isaac Herzog, saying they're thinking lucidly. We shall see. Thank you to Paul Wallace for all of that context. We'll continue to monitor developments, obviously. Joining us now is Abdul Qadir Hussain, Managing Director of Fixed Income Asset Management at Arkham Capital. Perfect day to have you in. Not talking about the weather, I'm talking about this move across the curve. 14 basis points. We're at the highs of the year now in US Treasuries. Were you anticipating that?
Well, I think the data has been speaking for itself. Retail sales obviously just sort of reconfirmed the trends that have been coming out in CPI and other inflation data. The U.S. consumer is in good shape. The economy is in good shape. The Fed really has no reason to move at this point in time. The markets, clearly at the start of the year were pricing in, 6 to 7 cuts, and now they're going through that adjustment process to price in, like you said, possibly no cuts. That's where we are right now. So.
What are you anticipating? Do we get a cut in December? Are we back to maybe even a cut by June, like some people suggest is still warranted?
I think, what we're trying to figure out is why the data is still coming strong.
Yeah.
Because even with lags, you should start seeing some indication of things starting to slow down, and you're not, right? So obviously, some of the things are fiscal. The fiscal policy still remains accommodative. Biden just forgave a whole bunch of new student loans recently. Immigration has been a big factor over the last couple of years. You have all these people coming in, something like 6 million people in the last 3 years. They're looking for houses, they're buying cars, the cost of car insurance, health insurance, all of these things, which is what driving up inflation. And I think until you see some of that data calm down, there's no reason for the Fed to move. So we don't think June is likely. We think right now, at the start of the year we were at 2 to 3 cuts. We were never in the 5 to 6 range. Now we're in the 1 to 2, but we think there's a non-zero probability that you might actually get a hike.
Which is such a range of outcomes, right? How do you invest in that kind of environment, and make sure you pick up the basis points that are on offer?
Yeah, I think the main thing for us to focus is you can't live from print to print. You can't live from Fed meeting to Fed meeting. You have to look at the bottom line. The bottom line is the regional bond index has a yield of about 6.4% across both high grade and high yield as a blended index. It has a duration of about 6.2, so that means you've got about 100 basis points of Fed of interest rate increases baked in terms of a break even. So for us, we're happy to just sit, earn the carry, earn that 6.2%, not take a call on interest rates in terms of being overweight or underweight duration, just be market weight. Let the chips fall where they may in terms of interest rates. But if you're earning that 6.25% carry, then you've got a fair amount of protection built into your portfolios.
It sounds like an ideal scenario and enough reward for the risk that you're taking potentially. Are there other spots in the market, be it regionally or more broadly, where you're spotting opportunities like that?
Well, I think you've obviously got story credits. So you've had Egypt obviously been a big factor. Now you've got the Egypt local currency trade that has come in, a lot of people jumping in. Obviously, the strength of the U.S. dollar kind of, brings that a little bit into focus, but that's still a relatively attractive place. You've got some of the sort of restructuring sovereign debt stories in the space. Pakistan is now in a slightly better place than it was, and is giving you good carry and defensive carry in short-dated bonds. So
you're finding, areas of interest in Egypt, in Pakistan. What about the likes of India in election mode right now?
Yeah, I mean, I think India is, again, relatively safe place for bonds, particularly, on the banks and the financials, and then some of the renewables are giving you decent yields. For us, primarily right now, it's about playing defense. We're not in it to try to gain capital appreciation, betting on interest rate cuts or declines in rates or spreads. Spreads are extremely tight in the region. We don't expect spreads to get any tighter. So, you're not going to get capital appreciation from either spreads or rates, so it's best to just sit and focus on the carry.
How do you hedge the currencies, though? Because obviously we're seeing, more and more weakness as the days go on.
Yeah, I mean, I think obviously if you're taking local currency exposure in some of these emerging market currencies, you kind of have to take a currency view. If you, for example, if you hedge out all of the currency risk in Egypt, you pretty much hedge out all your returns.
Yeah.
So you've got to kind of take that call. Particularly in Egypt, you have the flexibility that you're going in for 3 months or 6 months, relatively short periods of time, and given all the FX inflows, you expect that FX movement to be sort of muted. But in other countries, you have to use the forward markets and try to hedge if it makes sense to do that.
We have to leave it there, but thank you so much. So much context in a short amount of time in rainy season here in Dubai. That's Abdul Qadir Hussain, Managing Director of Fixed Income Asset Management at Arkan Capital. Plenty more still ahead. This is Bloomberg Middle East and Africa. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Vonnie Quinn in Dubai. German Chancellor Olaf Scholz says he will raise trade issues and the war in Ukraine during talks with Chinese President Xi Jinping in Beijing. Earlier, Scholz warned Chinese officials to address its industrial overcapacity and treat foreign firms better. For more on the visit now, Bloomberg's Oliver Crook joins us from Berlin. So, Ollie, the two leaders have met now. What more can you tell us about their conversation?
Yeah, Vonnie, it's just really this conversation about this sort of frenemy status that you have between Germany and China, where on the one hand, Germany sort of stands as one of the closest economic allies to China versus many of the other countries in the EU. But at the same time, they're very aware of the acute risks that exist with having an over-dependence with China. So as we mentioned, they're going into the meeting. Scholz was saying that he's going to bring up Ukraine. He's going to bring up those trade conversations that we've been hearing from Janet Yellen and from the EU, where it's been sort of ramping up its trade investigations, as well as sort of the energy transition. These are all topics that he's going to bring up with President Xi. And he said really that what he wants to do is he wants to see and to think about where we can make progress on any of these issues. The Ukraine issue, I think it's hard to get a big win for Scholz here. Really, maybe they can soothe a little bit of the concerns around trade. Scholz saying that both China and Germany are trading nations that benefit greatly from the World Trade Organizations that are committed to strengthening those rules. And really, it was China that overtook Germany back in 2010 as the world's biggest exporter. So both of these nations understand how important international trade is, and there are deep, deep trade relations between Germany and China. And you hear this repeatedly from executives who sort of push back sometimes on the de-risking strategy. We've heard from the German government saying that these supply chains and these trade relationships have been established for decades, and it's going to take a very long time to undo. So far, it's very sort of collegial and very sort of respectful, but I wouldn't say it's a sort of overwhelming sort of, warm embrace between the two leaders trying to walk that fine line.
Sure, and it does feel like Xi Jinping has had an earful about overcapacity, at least with the same from the US Treasury Secretary just in the last couple of weeks as well. Tell us more about how trade is looming over the visit. You said China had overtaken Germany in terms of exports.
Yeah, indeed. And what you have is the EU at the same time, and this is a story that we reported yesterday in a sort of scoop that we got, that basically you've already got the EV probe going on with the Chinese imports into Europe. They're looking into solar, they're looking into wind, and yesterday we understand that the EU is going to open another investigation into the procurement of medical devices and unequal trade practices. So this is really what's hanging over this visit between these two basic economic mammoths, and it's really something that is very, very sensitive to the EU now, and something where they're really ramping it up because the EU is feeling the pressure not just from China on, say, solar panels and EVs, but from the United States with the Inflation Reduction Act. So you have this sort of political impetus that's going into the trade conversation. And the issue for Europe is that it's also going to invite scrutiny into its own industries and its own subsidies and some of the issues that it has there, and indeed its own competitiveness, because there is the question of unfair competition, but there is also the question, and I think that China would make this point, that they've just outcompeted Europe on some key issues. And this is actually going to be the focus of the EU leaders meeting that's going to happen in Brussels later this week, which is what we're going to be covering a little bit later, is how does Europe, yes, deal with the trade issues, but how does it boost its own competitiveness?
Ollie, thank you so much. That is Bloomberg's Oliver Cook in Berlin. Let's get to some of the other stories of note this morning. Two of Tesla's top executives have left the company as the carmaker holds its largest round of job cuts. Senior Vice President Drew Bagligno confirmed an earlier Bloomberg report about his departure. Their Vice President of Public Policy and Business Development, Rohan Patel, also announced his exit. Tesla is looking to reduce its global headcount by more than 10%, which could affect some 14,000 employees. The Biden administration is planning to award more than $6 billion in grants to Samsung to help it boost its chip production in Texas. This as the South Korean chip giant eyes a $40 billion U.S. push. That includes investing in 2 foundry fabrication sites. Their facilities will produce 4 and 2 nanometer logic chips. That's one of the generations beyond the current state of the art. Donald Trump's first criminal trial has officially started, with the judge ruling that jurors will be allowed to hear evidence about the former president's alleged affair with an ex-Playboy model. Bloomberg's Kaylee Lyons reports from outside the Manhattan courthouse.
It was a historic moment as the first ever criminal trial of a former U.S. president got underway here in Lower Manhattan. Donald Trump has been charged with 34 felony counts of falsifying business records in relation to hush money payments made to porn star Stormy Daniels in the days ahead of the 2016 election. Trump has pleaded not guilty and denies the charges, and in the hallways of the courtroom on Monday suggested that he views this as political persecution, election interference, something designed to keep him off the campaign trail. It will indeed keep him off the campaign trail, as he is required to be here in person in court for each day of this trial, which could last between 6 to 8 weeks or even longer. They had a number of procedural motions they had to work through when this trial began, including a motion to recuse on the part of the judge, which he denied, and a motion, several motions related to what could or could not be submitted into evidence. Once they got through all of that, that is when jury selection began, and it's going to be very hard work. More than 96 potential jurors were brought into the courtroom, and more than half of them said that they could not be unbiased or impartial in judging this case because of the familiarity of Donald Trump, not just as a former president, but of course the current presumptive Republican nominee. So jury selection will have to continue. It's a process that could potentially take several weeks. Proceedings will begin again Tuesday morning at 9:30 a.m. Eastern time. And of course, this could have much consequence for the 2016 election. Bloomberg and Morning Consult have done a poll of the 7 key swing states likely to decide the election back in January that found more than half of voters in those states said they would not vote for Donald Trump if he were to be convicted of a crime. In Lower Manhattan, I'm Kaylee Lyons, Bloomberg News.
Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Bonnie Quinn in Dubai. Earnings season for U.S. banks continues, with Bank of America and Morgan Stanley due to report later. Goldman Sachs, of course, closing higher yesterday after the lender posted a surprise profit jump in the first quarter.
We feel very good about our first quarter results, which reflect the strength of our world-class and interconnected franchises and the earnings power of our firm. This performance was aided by the swift actions we took last year to narrow our strategic focus and play to our core strengths.
Let's bring in Bloomberg's Charlie Wells for more analysis. Charlie, how on earth did Goldman manage to come in with a stealth 28% jump in net income for the first quarter? Obviously, no one anticipated.
such a surprise, and it kind of made Wall Street bank earnings have a little bit more pizzazz than maybe they usually would have. And this was really Goldman going back to basics. So when you look at some of their core units, it's really hard to find an area that didn't beat. So they brought in $4 billion in revenue in fixed income trading, $3 billion, also a beat in equities trading, $2 billion in investment banking fees, also a beat, $1 billion in M&A advisory fees, also a beat, and their wealth management unit also beat expectations there as well, bringing in almost $4 billion. So this is a sort of scorecard that Solomon et al. Really wanted as they made that really difficult shift last year away from that flailing retail investment, retail banking effort, and these are the sorts of results that they were really looking for, and they really surprised the market. The share price increased as much as 6% yesterday.
Yeah, it was phenomenal. You got to think that people were maybe overreacting in terms of JP Morgan last week and now Goldman Sachs, but we'll see, maybe not. What should we expect from Bank of America and Morgan Stanley later today, particularly Morgan Stanley after shares fell off the wagon last week with that probe news?
Yeah, so, some difficult news for them ahead of earnings, a widening probe into anti-money laundering efforts in some riskier clients that U.S. Agencies are looking into. And there's been a lot of focus on Morgan Stanley's wealth unit. So Ted Pick, the new CEO who took over in January, he's called this unit the engine of the firm. But there's been some stress there as far as inflows, as far as profit margins. So there's going to be a lot of questions about that unit today. And thinking about Bank of America, I mean, the expectation is that should look a little bit like this earnings that we got from JP Morgan and from Wells Fargo, particularly with pressure on net interest income. So, that is the difference that banks bring in between, what they get from lending money versus what they have to pay depositors. And depositors are demanding more for those deposits, and there's more competition there. So that could be a strain for Bank of America.
All right, Charlie, plenty of messages to investors out there from these earnings, and we're into the final lap of them now, so we hope to speak to you again post Bank of America and Morgan Stanley. That's Charlie Wells there in London. But let's take a look at these markets because they are falling down today, just like the rain here in Dubai. Equity futures lower after a down day on Wall Street yesterday. Saw the S&P 500 below 5,100 for the first time in 2 months. NASDAQ, Dow Jones futures, Euro Stoxx futures also pointed a lot lower, pointed to a decline of 1.3% at the open. We saw it in yields too. We had stronger retail sales data. We have markets reconsidering now the rate cutting cycle and when it might start, and of course geopolitical risk. Daybreak Europe next.